Hi everyone, welcome to episode 29 of the Startup Playbook Podcast. My name is Rohit Bhargava, and each week I interview successful founders, investors, and subject matter experts on how they got started, the strategies they use to succeed, and their advice to current and future entrepreneurs. In this episode, I interview Simon Cant. Simon is currently the co-founder and managing director of Reinventure Group, Westpac Bank's $50 million venture capital fund. He is also President of FinTech Australia. Prior to these roles, Simon was an innovation specialist where he advised clients such as NAB, Tennis Australia, Suncorp and Fairfax. In this episode, Simon shares his thoughts on the relationships between startups and corporates, sustaining versus disruptive innovation, and why investors value referrals. Without further ado, here is my interview with Simon Cant. Hi Simon, welcome to the Startup Playbook Podcast, and thanks so much for taking the time to be here today.
My pleasure. Thanks for having me.
How are you finding Melbourne on this trip?
Cold. Very cold.
Bit of a change from
beautiful
Sydney.
And, there's a ton of interesting stuff going on down here.
Absolutely.
So good.
So for those listeners who may not be as familiar with you or with Reinventure, can you share a little bit of your background and what got you here today?
Yeah, sure. Just a little bit about Reinventure. Reinventure is a kind of new generation, as it were, corporate venture capital fund. And what makes us, I guess, new relative to other corporate venture capital funds or different is that the fund is actually set up as an entirely independent fund. It's owned, the managers own the management company. And the corporate investor, in this case Westpac, is a limited partner in that fund. So it's a kind of arm's length investor, if that makes sense. And that's quite unique amongst corporate venture capital funds because it means that whenever we're investing, our only way of really getting paid is through what's called carried interest. That's the upside that any VC makes when they get an exit with a venture. So it means that our interests are very aligned with the entrepreneur from the moment we invest. And that's probably one of the key differences compared to traditional VC. But I can go into that a bit more in a moment. That's Reinventure. How I sort of got to the Reinventure journey is I had my first experience in venture capital back in the .com era with an angel investment group called Tin Shed Angels. So we invested about 20 million in companies during that .com period, which was a place where we all learned a lot of lessons. And then after that, I spent a period in venture philanthropy with a group called Social Ventures Australia, and then post that I was involved working with corporations, helping them to come to grips with the nature of disruption. And during that period, which was sort of that kind of 2007, 2008, all the way through to the start of our fund, was a period where Australian companies were actually pretty unaware of some of the core principles of disruption as they've been articulated by Clayton Christensen, who wrote the kind of classic work, The Innovator's Dilemma. And so I spent a lot of time, in a sense, educating some of these companies about why some of the efforts that they were investing in around innovation were potentially destined to fail. And particularly I'd spent time with some of the media companies who were investing in their own classifieds to try and compete with the pure play classifieds, educating them about why the economics of their business was fundamentally not set up to be able to compete with the pure play classifieds, the car sales, the Seek, the REA. And that economics, if I can just sort of talk to it briefly, corporations are sitting on what we call yield capital. They have to pay a regular dividend to their investors. Their investors expect those shares to operate a little bit like an interest-bearing account. They expect the dividend to be paid consistently year in, year out. And what that means for those companies is that they are looking for innovations that will deliver pretty predictable near-term returns. Okay, it's not really workable for them to make any significant amounts of investment into things that may not pay back for 5, 7 or 10 years, all right? Because every dollar they put into something that won't pay back for 10 years, they need to find something else that's going to pay back $2 in a short time frame with the rest of the money from the companies. So when you take a company like the print media companies, the newspaper companies, particularly once they start going into decline, that urgency to try and find the money that they can give their investors their dividend through becomes even more pressing, right? So their ability to be able to place these long-term bets becomes even less. So what you ended up with, if you look at the way the classifieds played out, was that, Fairfax, to take the specific example, from quite early in that sort of 2000s decade, was expecting its digital classifieds drive, Domain and My Career, to contribute to the corporate dividend, and found it quite difficult to actually invest into those classifieds, right? Because if it wanted to, it needed to go and raise money, and if it wanted to raise money, it had to raise it at 4 times earnings, which is 5 times earnings, maybe a bit more, but expensive money. At the same time, car sales seek REA. Firstly, every dollar they made, they weren't paying a dividend until very late in that decade. So every dollar they made, they just ploughed straight back into the business. And secondly, they could go and raise money from the markets at 26 to 30, 40 times earnings. And that is cheap money. So when they're going and raising money like that, they can afford to put even more into their growth. So you essentially had those companies investing year in, year out in billboard advertising and all sorts of other media presence to grow their business, whereas Fairfax just had to rely on, its presence within the newspapers, which is strong, but it just did not invest in as much marketing and couldn't afford to as the pure plays could. Now that is a story that plays out again and again with disruptive investments. Any of those investments that are not going to pay back for a really long time, and particularly those that have a kind of winner-takes-all dynamic to them, right? Like classifieds do, any two-sided marketplace or other marketplaces. It's quite hard for incumbents to make the economics work, to make those longer-term investments, particularly where they don't really know how it's going to play out. So as a result, that was the kind of work that we did, sort of. Educating some of the incumbents who just hadn't got their head around the economics. And the economics drive everything. They drive the culture, they drive the organisational structure, they drive right down to the choices about what are we going to put, what sort of innovations are we really going to dive into. So for Fairfax, it makes it much more attractive to go and put another $1 into a glossy real estate magazine, which is going to pay back fast because you can sell every quarter page for $3,000 or $4,000 or $300 or $400, whatever it is that they charge. Whereas putting it into the digital classifieds, where at the time, for example, realestate.com were selling all of the properties within a real estate agent could be put online for $500 at a certain point. That versus quarter page ads, you're going to make 10 times the money out of those quarter page ads in the glossy real estate magazine. So that was where it made sense for them to invest their money.
Sure. So do you think, obviously the last few years especially, there's been so much focus on the innovation boom and startups in general. Do you think that that's played a role in changing some of the culture? So
I think that they're still getting their heads around it, is what I think happens. So now I think these corporations understand that disruption is difficult. But I guess where Reinventure comes in is it's basically a new way to try and deal with those economics. So essentially, for a large corporation like Westpac, by committing to a fund, so in our case, we're on our second $50 million fund, they set that money aside and they say to their investors, that money is long-term patient capital and it's committed, okay, sort of locked up. And by giving it that quality of long-term patient capital, it allows us to invest in disruptive startups in a predictable way over time. Okay, so we invest like any good VC invests, whereby we make initial investments in a company, but we also keep reserve capital for that company for later stage investments. So we have that predictability. Companies that are taking our investment know that we do have money to be able to invest in those that are successful, if they as they need it as they grow.
So obviously you have a background in the innovation space for corporates.
Yep.
Over an extensive timeline. What are some of the things that have changed from when you were first doing that, during the first .com boom, when you were also looking to invest, versus what's kind of taking place now?
Well, there's a bunch of really important changes, both in the startup ecosystem, primarily, and also in corporates. I think corporates are still evolving. In the startup ecosystem, the most fundamental changes are the existing infrastructure that is essentially the infrastructure that can be rented by any startup. That ability to rent your infrastructure is something that is very different from in 2000, where you essentially had to manage your own servers and build most of your tech from the ground up. Today, most startups are in the cloud, and a lot of the services they might use, be it security, be it identity checks, be it accessing, bank data, all these services are available on a rentable basis. So you can actually build a startup by plugging together bits of Lego pretty quickly and pretty cheaply. That's a massive difference from how things were in the year 2000. The other thing that's different now is there is a real depth of understanding in the startup ecosystem about just the methodologies around building a startup, the whole lean startup methodology, etc. So that's different. That didn't really exist back in 2000. There were actually a bunch of writers who were writing about it back then. It used to be called Discovery-Driven Growth by Rita McGrath. She wrote a book back, I think it was in the 2000s, possibly in the 90s, about essentially the same stuff as lean startup. But it's really been refined and it's been articulated for developers.
So I guess coming back to Reinventure, what is it specifically that you look for in investment opportunities?
Yep. So we've kind of got 4 pillars that we typically look for. And I should say it's evolving a bit over time, but the 4 pillars are a good starting point for people to think about. Firstly, we're generally looking for proven models, okay? So what that means is when we invest in at the early stage level, a lot of the stuff that we're looking for are models that we're seeing getting traction overseas. So if you look at an example of something like Society One, it's similar to a lending club. If you look at something like Neighbour, it's quite similar to something in the US called Nextdoor, etc. So we'll tend to invest in a lot of things that models we're seeing work overseas, what are sometimes called fast follows. Secondly, we look for proven entrepreneurs generally. So we're generally looking for people who've had an exit before and are therefore, particularly when you're going into a fast follow type business, are going to be able to scale and execute on that business quickly. Does that make sense? Because it's often a race to market when you're doing these sort of fast follow businesses. Thirdly, we look for things that tend to be inherently regional. Westpac has a big footprint in Australia, so we're looking for things that can be big businesses in Australia. That typically means we'll be looking for things that have a big network effect. That might be a marketplace type network effect, or it might be a data network effect. So things that, AI that builds intelligence around a particular domain, for example, might be the sort of thing that we'd also invest in. But it'll be a network effect of some kind that means that the market will be a winner-takes-most market. Because if you're operating in Australia only, there aren't many markets that are big enough for it to create a large business if you're only 2 or 5% of the market. Yeah. And then the fourth element is it's something that Westpac will really lean into to create real advantage for the business. So, and that's where often it's about, is there some kind of two-way value exchange that could go on, some kind of synergy between the businesses that would make it something that Westpac would be excited to lean into. That being said, there are others where we've had them to lean in for reasons of, there's a real brand fit, or, they're just excited about the business and they can see the potential of it.
Sure. So you mentioned that one of the things that you look for in founders is a background of having previously exited a business. Is there any other sort of experience points or characteristics that you look for in the founders specifically, and potentially dynamics in teams that you're investing in?
Yeah. So, we look for... So it's two things. Firstly, I'd say, so that's the starting point for our investment sort of lens, as it were. There are occasions where we've invested in first-time founders. And there are occasions where we've invested in new model discovery. So increasingly what we'll tend to see, if something is in a theme that we're particularly focused on and excited about, then we'll start to look for one or other element, but not necessarily all of those elements. Yeah. And that's particularly at the earlier stage. We're starting to look for, there are increasingly some of those new model discovery things that we have invested in. Okay, that's the first point. In relation to what else we're looking for in founders, like other VCs, you are investing in people that you're going to have a long relationship with. So we like to invest in people that we can get on with. So people who are able to take feedback, and also people that will be honest back to us, are all important qualities, because things get pretty tense at times in an investing relationship. You often have to deal with some difficult situations in any startup, and so you need to be able to go through those scenarios with a founder and come out the other side.
Absolutely. And I was just going through your website, and one of the things that were mentioned were that you, I don't know if specifically you only talk to founders that have been given a warm introduction, or you sort of prefer it, but why is it that referrals are not critically important, but why does it make such a big difference for investors?
I think there are a couple of reasons why referrals are important. One reason why referrals are important is that you see so many investments that it's helpful to find a filter other than, a slide deck, because a slide deck only communicates so much. So filters being people whose opinions you trust can be really strong signals. Yeah. So that's the first thing. Second thing is, a venture that comes through those filters, that comes through from some of those strong referrals, are likely to be those ventures who can also get support from others, right? One of the key things with backing an entrepreneur is you need an entrepreneur who others are also going to be prepared to back over time, because it's rare that we would be the only investor in a startup. And it's not only about attracting investors, it's also, are they going to be able to attract staff or great talent? Are they going to be able to attract great partners? All of those things are really important, and so being able to access a good referral network is a really good telltale sign that you're just somebody who's going to be able to attract support. Does that make sense?
Yeah, absolutely. I think one of the things that's often overlooked on, especially first-time founder side, is when they're looking for referrals, they'll look at an investor and say, they've got money, I need to go and talk to them, rather than looking at specifically what are some of the verticals they're interested in, or what those, what that VC is actually interested in investing in. Sometimes that referral might say, that's not the right person for you to talk to. Maybe you should be talking to someone else as well. So it prevents the time wastage on both sides. Yeah,
I mean, some of the entrepreneurs we've invested in, have a bunch of, so some of them came through referral. We've known them from previous ventures. Some of them will come through angels that we know and trust. Some of them are people who've just had a ton of chutzpah and they've managed to come through. For example, one of them emailed someone super senior in the bank, or I think they reached out to them on LinkedIn, and they obviously did it in a compelling enough way that the person actually responded to the contact. So all of those are great signs of the sort of chutzpah that you need to know that this person is really going to be able to build a business.
Sure. And I guess as one of the few truly independent sort of corporate VC firms that are operating in Australia, I'm just wondering, do you think it's been a positive or a negative for you, if any, in terms of trying to attract the type of founders that you want to work with?
It's got swings and roundabouts. So I guess one of the challenges is we've had to educate the market about our model, and we continue to do that. So really educate the market that we are not going to be investing through a lens of what is strategic for Westpac, and we're not going to come in and start bending the entrepreneurs' needs to those of Westpac's. For us, it's all about what's going to generate the best outcome for the venture. Yeah. So it's been a while. It's taken a while to really educate the market, and we continue to do that. So that's made it harder, I think. The fact that Westpac has a whole, bunch of great assets, I think has been a real positive. What we don't have that some of the other VCs have is this large base of LPs who might be founders of companies themselves in a previous, in a previous era, and they can be a great referral network. So we don't have that referral network. So we've put a lot of energy into building up new networks to try and create it. So we've put a lot of energy into the establishment of Stone and Chalk. We've put a lot of energy into helping FinTech Australia get up and running. All of these sorts of things have been ways to sort of build connections into the community.
Sure. And I guess more generally on an ecosystem level, what role do you think that corporates should play, if any, in the startup ecosystem space?
I think they can play an important role in this country because, I think they've got a lot to lose if they don't partner with startups and get behind startups. What I would say is that the way they do that relationship is really important. So we would love to see other corporates set up very independent funds using the same sort of model. Currently, we're set up as an ESVCLP under the Venture Capital Act. Currently, only banks, life insurance companies, and I think super companies can actually set up ESVCLPs. All other corporates are not allowed to under the Venture Capital Act. So we've been pushing for that to change because we think it'd be great for the Telstras of the world to be able to set up with that same structure, for the Qantases, for the grocers, all of those companies to be able to adopt the same structure. And I think a lot of them would like to be able to adopt it as well, potentially. So, I think healthy corporate VC would be really important. I think unhealthy corporate VC where, you're having that difficult relationship where they're, in a sense, trying to have too much influence over the startup to try and make it meet the needs of the corporate rather than looking at how the corporate can meet the needs of the startup. I think that's where it gets unhealthy.
Sure. And so you mentioned that this is Reinventure's second fund as well. Is there any sort of change in strategy or change in focus with the second fund as opposed to the first fund?
There's been evolutionary change. So as I said, we've started doing a few what we call new model discovery ventures. So ventures that aren't fast followers of things we've seen elsewhere. And the reason that we're starting to do a few of them is that, for example, if I look at where we've tended to invest, we tend to look at the financial services stack, as it were, and we see different layers of the stack and think about each layer differently and invest in each layer differently. So almost above the financial services stack sit all those marketplaces, things like Uber and Airbnb, and ones that we've invested in like HeyU or Neighbour, the neighbourhood social network, and also those SME platforms like Flare, which is a free HR platform, things like that. They sit above the financial services stack and increasingly are having financial services embedded in them. That's one of the big changes for financial services. So that's one layer that we invest in because we think we can actually use the large customer base that Westpac has to get a foot into some of those marketplaces. When we look at the pure, what we call fintech usually, so lenders, robo-advisors, all of those sorts of things, payments companies. Some of those are disruptive, some of them we'd probably call more sustaining. But we have made investments in some of the ones that we think are more disruptive. So things like Promise Pay in the payment space, things like Society One peer-to-peer lending we think is potentially disruptive. Some of that we've invested in an SME broker, an SME lending broker called Valiant. So these are all things that we think can be quite disruptive at that layer, but a lot of the things at that layer in pure fintech are, in our view, quite sustaining. So particularly, for example, we haven't invested in a pure robo-advisor because we're not sure that is actually going to be particularly disruptive. Well, we think it's going to be disruptive to wealth advisors, but we think it's quite likely to be owned by asset managers, because while it's disruptive to wealth advising, to asset management, it's a sustaining innovation. So we've done some investments there, and then you go into the stack, and essentially financial services players, banks, are giant pools of data. They've got enormous amounts of data in them, and therefore they are big consumers of data services, etc. So we started investing in that data services layer, and if I look at some of the newer investments that we're starting to make, increasingly we're seeing we've made a couple of new model discovery investments in that kind of data services layer because of some of the existing ventures that we have there that have been real attractors for new ventures.
Sure. So on the sustaining versus disruptive innovation startups, how do you sort of compare the two? If there was an opportunity that was more sustaining versus an opportunity that was more disruptive.
Yep.
Do you have sort of different metrics that you look for, different sort of ways of approaching the opportunities?
Well, so we try not to invest in sustaining innovations typically. We're looking for disruptive innovations. And the reason is that sustaining innovation should be those things that an incumbent wins at itself, right? Now, sometimes startups will get out ahead of an incumbent on a sustaining innovation because they're just quicker and more agile. But in those cases, the venture should often look for probably a reasonably early exit, because at some point the incumbent is going to say, right, we need to go after that particular feature or that particular new product because it's going to grow our business. And when they go to invest in that space, they'll make a buy or build decision. And you need to make sure that if you're a venture in that space, that they make a buy decision and that you're one of the ventures they look to buy. So if you take on too much VC as a sustaining innovation, you can price yourself out of that buy-build decision quite quickly if you're not careful. So we're big believers in ventures that are sustaining. Firstly, being clear on whether they're sustaining or disruptive. And secondly, if they are sustaining, making sure that they don't take too much money on and that they stay very closely connected to their potential exit partners and be ready to exit when the time is right.
Sure. And you've touched on this a few times, but obviously Reinventure and you yourself have been really big supporters of the fintech community and the ecosystem here. Are there particular areas within fintech that you yourself are really interested by or you think have a lot of potential for startups?
Look, we think long term, we're interested in a whole bunch of areas. As I said, data we think is super interesting, and data really is at the base of most of the AI innovation that's going on, machine learning, etc., natural language processing. So the way that space is evolving we think is super interesting, and we're definitely interested in ventures in that space. We think that the open blockchains are very interesting. We're probably less focused on private, what they call permissioned blockchains, because we think that they'll largely be dominated by the existing incumbents. But we're very interested in the open blockchain. We did make an investment in Coinbase, which is the largest US Bitcoin wallet operator. But we're interested in all sorts of things that are being built on both things like Bitcoin and the open Ethereum blockchain, etc. And I think that's going to be one of those very long, slow burns. History says that open ecosystems tend to overcome closed, permissioned ecosystems over the long term. And there's I think a lot of reason to think that might be the case with blockchain. So, but long journey. and it's still unclear where some of the bigger opportunities are going to emerge there.
Sure. So Simon, for anyone that wants to find out more about you or Reinventure or get in touch, what's the best way for them to do that?
A warm lead. Look, try and get involved in some of the ecosystems. It is actually it's a great thing to go in places like Stone and Chalk, which is where we operate out of. There's also H2 Ventures in at Stone and Chalk, so they can be a great way to connect with us. But we're also involved in FinTech Australia, so that can also be a good way to connect. But the ideal way in many ways, as I said, is to go, if you can find great angels, we're always trying to meet and develop networks and relationships with the good angels, and entrepreneurs should be as well. So that's the best way to try and get that relationship with the VC. Good angels have relationships with good VCs, and that's, for most ventures, I would say, the best way in. Don't shoot straight for VC.
Fantastic. Simon, thanks a lot for your time today. That's been tremendously insightful.
Pleasure. Thank you.
Thanks for listening to episode 29 of the Startup Playbook Podcast. You can find the show notes of my interview with Simon, along with a curated list of tools and resources for startup founders at startupplaybook.co. As always, you can join the conversation through our Twitter account. The handle is @PlaybookStartup. In the next episode, I interview Adam Jacobs. Adam is the co-founder and managing director of The Iconic, Australia's online destination for fashion and footwear. In the episode, Adam shares the importance of focusing on your customer segments, how to stay ahead of competitors, and building credibility with customers. Don't forget to subscribe to stay up to date with our latest episodes. Thank you for listening, and I'll see you at episode 30 next week.